Earnings season is here, and some of my favorite dividend stocks are reporting earnings, and the reports, they're actually really good. And so I want to share 3 earnings reports today and how I look at them as a dividend growth investor. I invest for dividends and cash flow. I invest for dividends that I can use to pay my bills. And so I want to go through the earnings reports for United Technologies, Hasbro, and Kimberly-Clark. Again, these are 3 stocks I own in my personal stock portfolio. Now, I don't place too much weight on quarterly earnings. I like to place more weight on annual reports. I look at all the annual reports because I'm investing forever. My investing time horizon is literally never to sell, and so I'm looking at very long periods of time. And so fluctuations from one quarter to the next, they don't matter too much, but nonetheless, I do follow them. And I want to share with you today the methodology that I personally use to look at these earnings reports. So let's get started. All right, everyone. So I have a lot of my subscribers here on YouTube now following me on Twitter, and there's been a lot of good discussion on Twitter about these earnings reports. So if you're not following me on Twitter yet, check out the description below. You can find me, the link there to be able to find me on Twitter, and you'll be able to see some of these earnings reports there that I'm sharing firsthand. But I want to jump into it. How do I look at these earnings reports? What do they mean to me? Again, they don't mean a whole lot, but I'm going to go through them. So United Technologies, the first one, this is my number 4 favorite dividend stock of all time. I think they are completely overlooked. I think a lot of people do not look at this company. It does not get the type of press that a company like 3M, for example, gets, and 3M is one of my holdings as well. I love 3M. But United Tech, it's kind of under the radar. And I think United Tech right now, everyone is avoiding it because it's going to be splitting into 3 companies, 3 separate units, and I am taking on that risk ahead of time. There's a lot of unknowns. Who knows what's going to happen after the split? What is the dividend policy going to be for each of the individual companies? No one knows. Because of that, I believe the stock is trading at a relative value compared to its peers. It's trading at a relatively lower PE, in my opinion, as I calculated, as compared to some of the peers. And a good peer being 3M, for example, another industrial company. And anyways, I'm taking on that risk. Because there are unknowns, because I don't know what's going to happen after it breaks up, I'm buying now. I'm just buying now because I think it is going to unlock value when it splits into 3 companies and some of these unknowns are resolved. Anyways, they came in with earnings per share of $1.91 versus the consensus analyst estimate of $1.75. Now, I don't really care what analysts think that much, so whether they beat the analyst expectation or meet it or come in lower, that doesn't matter quite as much, but the street cares, and so the stock is way up. But what matters to me more is that the earnings per share was $1.77 a year ago. So $1.77 in the comparable quarter a year ago comes in at $1.91 the comparable quarter this year in 2019, Q1. That is 7.91% growth year over year. So this company, this industrial company, I actually look at them as a technology company. This is a perfect example of how owning a dividend stock, a quote-unquote boring dividend stock, it can still be a growth stock. They're growing their earnings year over year. It's up 7.91%, almost 8% year over year earnings growth. That is serious growth. That is really good, especially for a company of this scale. This is a very big company. Now, moving on, revenue was $18.37 billion. And this is versus $18 billion consensus estimate from the analysts. And so they beat the analyst expectation on revenue as well. And look, that's the scale I'm talking about, $18.37 billion. That's huge. Moving on, they raised their guidance. So for 2019, they previously had given a range of guidance. Hey, this is what our earnings per share is going to be for the year. They actually came out and said, look, we're going to raise that guidance. Now, they give a range. They give a range right now of $7.80 to $7.80 to $8 a share. I think previously the low end of the range was lower, so they didn't raise the top end of the range, but they just raised the lower end of the range a bit higher. But that's nice to tighten up the range and to reaffirm confidence to Wall Street that they're going to do really well this year in 2019. So I just run some quick numbers. The dividend is $2.94 per year. They pay it quarterly, but if I sum up the quarters, that's what it is per year. I take my $2.94, I divide it by my $140 and change share price. The dividend yield on this one, it's really low. It's 2.1%. That's the current dividend yield. But this company has a history of raising the dividend each year. And my hypothesis is once it breaks into 3 separate companies, they will continue to unlock dividend value for shareholders. That's the bet I'm taking. That is the risk I'm taking here. And I hope it pans out. Now, when these 3 companies exist independently, one for their aerospace and jet engines, one for their elevators, one for their HVAC equipment, I don't know if they're going to pay dividends right away. I don't know if they're going to be raising dividends right away, but I'm looking at this for the long term. I imagine after the first few years of each of these companies being independent, I am guessing here, I'm betting here that they will unlock dividends and that they will maintain a similar strategy to the old parent company. Now, what's great about this low dividend yield and this high growth rate of this company is it leaves a lot of room for them to raise the dividend over time. So the current payout ratio, if I take the current dividend and I divide by the low end of this consensus or of this guidance range, I get 38%. So 38% payout ratio on a forward 2019 basis, that's really low, gives them a huge amount of room to increase the dividend over time. The current PE ratio on this stock is $140. I take the low end of the range, 7.8, from the guidance that they gave, and I get a PE forward for 2019 of 17.95. Now, 17.95 is not a very good PE. It's not a very attractive PE, but as compared to most of the other stuff out there in the market, I like this stock even at these levels at 140. Now, I'm really happy that I bought a lot of United Tech this year already up until this point. And I even have mentioned this in prior videos that of the stocks I'm buying, I think it's a relative value. I think it's a relative value to other stuff in the market. I think it's overlooked. And I still actually maintain that viewpoint. Now, it's getting a little more expensive at a 17.95 PE, but at the same clip, they are raising earnings 7.91% year over year. So for getting a company that is growing this quickly, of this stature, of this stability, that has this kind of dividend, with a few unknowns about the split up, I like the valuation here, despite the fact that the chart is up and to the right. And so I personally have slowed down my purchases of United Tech here, but I do envision that I will be buying more United Technology throughout 2019, and I think it's a reasonable valuation as compared to most other stuff in the market. Now, overall, the takeaway here is if I think a 17.95 PE is a reasonable valuation, that is a sign of the times. That is a sign of the times that right now this is an expensive market. I'm treading with caution with new purchases. I'm going a little lighter on new purchases because this is a very expensive stock market right now. That being said, I'm always averaging in up markets, down markets. To reach my goals for passive income, for financial independence, retire early, I need to deploy a lot of money. And so I've got to always be deploying even in bull markets like the one we're in now. But I wouldn't be surprised if we see a correction soon. Anyways, I want to move on to Hasbro. A lot of dividend investors overlook this stock. I don't hear any chatter in the community about it. I like this stock. I've been in this stock a while. I have 2 young children, and I can tell you that Hasbro toys are very popular in our household, and I'm a proud shareholder of Hasbro. This is a very diversified company. They are in many different elements of the toy industry. So they offer toys like Play-Doh, for example. They offer traditional toys like Transformers, but they also license their intellectual property to Hollywood to produce movies like the Bumblebee movie, these Transformers movies that do really well. You might not know, but they also own the popular game Magic the Gathering. And Magic the Gathering, I think, was a huge, huge successful acquisition of them. And they're taking a lot of their games as well and bringing them online as well. So this is a diversified company. They're doing really well. A lot of people thought that they were just going to fail with the bankruptcy of Toys R Us and with Toys R Us going out of business. Now, they're not. So they came in this quarter, Q1 of 2019, and they came in at 21 cents per share. Now, this is versus a consensus estimate of losing 8 cents a share. So the analysts thought these guys were going to lose money. They came in with a pretty solid quarter. Now, a year ago, in the same quarter, they only made 10 cents a share. So 10 cents up to 21 cents is a gain year over year of 110% growth. Now, is that the real growth of the company? No, this company's not growing year over year 110%, but the comp last year was pretty low, and so they're kind of finding their footing. They're getting back into the game. They're figuring stuff out, and quite frankly, they are thriving despite the fact that they face some headwinds with the whole Toys R Us issue. Now, moving on, revenue. Revenue is up 2% year over year, and so their top line is growing as well, and that's really nice to see. Again, without Toys R Us helping prop up sales, they are still able to grow revenue 2% year over year. And so I ran some calculations, and the dividend is $2.72 per year. Again, they pay it quarterly, but that's if I sum up the quarters. By the way, they have a track record of raising the dividend really aggressively. And so sometimes I just like to go to NASDAQ. NASDAQ has a very good data on this, and they can share with you any stock you type in what the historical dividend data is. And if you look at the historical dividend data for Hasbro, you'll see that they've raised the dividend really aggressively. So this is a true dividend growth company. The company is growing, the dividend is growing, everyone is happy, everyone can take that cash flow and use it to buy stuff to pay bills without selling shares. Now, moving on, if I take the dividend, I divide by the current share price of $100 and change, the starting yield is a 2.7%. 2.7 isn't a huge starting yield, but again, this is a company with a lot of upside. It's more of a dividend growth company versus a slower growing dividend, higher starting yield. And I like to have these kind of companies in my portfolio. If I look at the PE, if I take the, now this one, I didn't find guidance that they provided on their PE or on their EPS for 2019. And so what I did is I went to Yahoo Finance and I looked at the analysis. I looked at what the analysts are expecting for 2019. The analysts' expectations, though, are probably before this current earnings report. And so they probably are understating what they can do. Anyways, if I look at the average of what the analysts think they'll do in 2019, it's $4.30. And so that implies a current PE of 23.4. Again, I think the real, or a forward 2019 PE of 23.4. I actually think that PE will be a little bit lower because, again, the analysts' expectations were before they came in and beat earnings. And so that's something to keep in mind. But certainly an expensive stock, Hasbro at a forward PE of 23. I'm not buying it here, but I'm happy to own it. Real proud of them. And so the payout ratio, if I take the dividend, I divide it by the 4.3 EPS, it's about a 63%. So higher payout ratio. Again, if these guys were smart, honestly, they'd probably slow down their dividend growth rate just a little bit until they fully get past all this Toys R Us stuff. But it seems like they're definitely turning the corner here. Everyone is happy. The stock was way up. It was up like over 10% in one day. And it's doing really well. But again, this one thing worth mentioning, the reason the report was so good for these guys is the strength was in, I know in Magic the Gathering, Play-Doh, their online stuff, and also the entertainment and licensing for the Bumblebee movie. Now, can they keep replicating their success with these Transformers movies? I don't know. I certainly hope so, but I do expect in the future the earnings, they could be volatile based on that licensing revenue. And I do think, certainly at a PE upwards of 23 on a forward basis, this is priced very high. This is very expensive here. And so again, I bought a lot lower. I did a video on Hasbro. I'll link in the description below. I don't know if a lot of you guys have seen this video. Check it out. It's a real fun video. But yeah, I'm not buying here. And this is honestly one of the reasons I look at these earnings reports is just to get a sense. Ian, should I be buying here? Should I not be buying here? United Tech tells me, look, I'm okay buying here. I'm going to buy some here. Hasbro tells me, Ian, good for them. They're doing really well. You should be a proud shareholder, but don't be buying here. And so that's why I look at these quarterly earnings, quite frankly, is to determine where do I allocate my money. Moving on, you probably can't see this. It's cut off on the board. This board got filled up really quickly, but I want to talk about Kimberly-Clark really quickly. Kimberly-Clark, if you remember, is one of the top two stocks I was buying in 2018. I bought a lot of it in 2018. I'm happy I did because for a lot of that year, the starting yield was at the 4% range. There are times when it's even a little bit higher. Now the starting yield is really low. It's at a 3.3%. And so I'm not buying here. What was weird about Kimberly-Clark is off the bat, the streets, the investors liked the report, but now it's kind of coming back down. And I was surprised the day the report was released, the stock went up. because I honestly didn't think the report that was that good. And this is another lesson for all of you. If you see earnings reports, quarterly reports, and they're kind of okay, but the stocks rally on that news, it sometimes is indicative of a market that's overheating. People are just searching for good news, and they're just buying, and they're buying without fully thinking. Again, I own Kimberly-Clark. I love it. I'm not buying it here. I think the stock is priced pretty much to perfection, certainly not at an attractive valuation like it was in most of 2018. But anyways, the revenue was down. It was down 2% year over year. That was the first thing. I'm like, the stock is rallying when revenue is down. Now, they did qualify that organic revenue when they factor out things that they can't compare, and also they factor out foreign exchange rates. The organic revenue was up 3% year over year, and they're still indicating that they're on track for organic revenue growth of 2% year over year for the year. Fine, is that 2%? Come on, is that very exciting? Is that a reason for the stock to rally? It's good. It's like, hey, you're doing all right. You're keeping up with inflation, but I don't know. It just didn't get me that excited. Now, the adjusted EPS, earnings per share, it came in at $1.66. That's versus $1.71 last year. And so revenue adjusted organically was up 3%, and they're forecasting 2% for the year. But earnings per share, it was actually down year over year. And they had some good stories that came out of this report. One of the stories is they're doing okay by increasing prices and passing the price increases along to the consumer. So that's working out for them. But with the revenue organic growth of 3%, and they're expecting 2% for the year, but with EPS going down from $1.66 versus $1.71 a year ago, like I said, this is an okay earnings report. Okay, certainly is it indicative, hey, this company's turned the corner and they're doing great? Not really. And so the fact, again, that it rallied on this was a little weird, and it was kind of a red flag to me that, hey, Ian, watch this market carefully. This is getting a little top heavy here. Now, I don't want to put down Kimberly-Clark because I love this stock. It's one of my top 15 favorite stocks of all time. I love owning it, and I'm in this forever. And so I'm looking like 20 years out, 30 years out, 50 years out. Are people still need diapers? Do people still need Kleenex? Yeah, of course. And if you have kids like I do, you'll quickly realize, like we use Huggies diapers, how quickly you can go through Huggies diapers. It is serious. It is so serious. It's a lot of diapers, a lot of money. And so Kimberly-Clark, I like their business model, and I feel good about them for the long term. But looking at this micro level snapshot of this quarter, is it the time for me to buy more? Heck no. And so moving on to the dividend, it's $4.12 per share per year. Again, they pay it quarterly. I just summed up the quarterly. That implies a dividend yield of 3.3%. The forward PE based on consensus estimate is implied at a 19. That's not bad. So that kind of gets me thinking a little bit better. Certainly, if I had to place money right now between Hasbro and Kimberly-Clark, which would I buy? I'd buy Kimberly-Clark, because even though Hasbro is growing, PE at 23, it's just awfully high. But a PE of Kimberly-Clark at 19 with just very slight revenue growth, with a story that EPS is going to come back, with the world-class portfolio of brands that does not have the kind of volatility one may face when they're reliant on the entertainment industry like Hasbro is. Certainly I go Kimberly-Clark all day, every day over Hasbro at current valuations. And again, that's why I look at these earnings reports. Now, payout ratio is 62%, so payout's a little high, which means going forward, likely the rate of dividend growth of Kimberly-Clark is going to be a little lower. And what that tells me as well is, because I believe the dividend growth is going to be a little lower, I need to only buy Kimberly-Clark when it's at a sale price. And a sale for me is when the PE is probably down closer to like 15 to 16, and it's when the dividend yield, the starting yield, is in that 4+% range. Because if it's not, knowing that the dividend growth is slow, I'm not going to be buying it at a 3.3% starting yield. Certainly, I'd feel better about buying United Tech at their, 2.1% starting yield, just because I know there's so much room to grow the dividend. Now, they may not do that very quickly. It'll take time. But then again, I'm not going to retire tomorrow, so I've got time. I've got time to wait for United Tech to increase the payout ratio and give more money back to the shareholders. And so this is why I look at these quarterly earnings reports. It just literally gives me more perspective on how I should deploy my capital. I love all these companies. I love 3M too, but just looking at these gives me insights. And so I'd be curious, what did you think about these earnings reports? Are there other earnings reports you've been following? How do you use earnings reports as an investor? Share in the comments section below. We are 25,000 dividend investors strong. We are a thriving community. We are dividend investors supporting other dividend investors. So please chime in, share your thoughts with the community. I appreciate it. Everyone here appreciates it, because at the end of the day, we are all looking to improve our investing. We are all looking to become better investors, and the community participation is everything. If you want to thank me for the videos that I publish here on PPC Ian, the best way you can do it is to subscribe and to check that little bell so you get notifications when my videos are released. And also, one thing I would be forever grateful for is sharing my channel with anyone you think could benefit from this investing strategy. I'm also on social media, so check me out there. All right, everyone, before we leave today, just a full disclosure, I own the stocks mentioned today. I am long 3M, ticker symbol MMM. I am long United Technologies, ticker symbol UTX. I am long Hasbro, ticker symbol HAS, and I am long Kimberly-Clark, ticker symbol KMB. I own all of those stocks in my personal stock portfolio. Also, in terms of a friendly disclaimer, I'm not a licensed investment advisor. Today's video is not investment advice. This video is just for your fun and entertainment. If you're going to go out and invest money in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey for fun and entertainment here on YouTube. All right, everyone. I will see you in the next dividend investing video.